Dissecting the Dow Jones 30 Industrial Average. Here we're looking at a long-term chart. It's an interactive chart that shows that the Dow has steadily gone up over the years with the occasional interruption. And we can also see by looking at the last year of the Dow this year that the Dow is down. But has the Dow become cheap or is it still expensive? What we're going to do in this video is dissect the 30 Dow stocks and look at them individually. I'm going to argue that roughly half of the Dow stocks are overvalued or still overvalued, while half of the Dow stocks are currently attractive at a fair value. And I'm going to show you how quickly we can dissect the Dow Jones, because even though it represents the market, it's only 30 stocks. Hello everybody, it's Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. And one of the questions I've been asked several times over the last several weeks is, have I looked at the Dow? And you know, the truth is I look at the Dow almost every day. The reason I do that is because I've got the good fortune to be a subscriber as well as the co-founder of the FastGraphs Fundamentals Analyzer software tool. And one of the things that we have in the FastGraphs Fundamentals Analyzer tool is we have some preset portfolios available to premium subscribers, and one of those is the Dow Jones. So let's go ahead and go in to the FastGraph tool. It's a tool that, I can't imagine investing in stocks without it. And what I'm hoping to do with this video, and I'm going to give you a shameless commercial here, if you invest in stocks, you ought to invest a little bit of your money into good research. And I believe the FastGraphs Fundamentals Analyzer software tool is one of the best valuation-based research tools you can have. So let's go ahead and get in the tool. As you can see here, what I have is the 30 Dow Jones Industrial Average listed here. It's this group of 30 stocks, household names, most of them, McDonald's, Microsoft, Disney, Nike, Visa, UnitedHealth, Apple, Walmart, Procter Gamble, and it goes on and on. So these stocks are a microcosm of the market. And you can see they come in all different sectors, information technology, communication services, consumer staples, healthcare, industrials, financials, energy companies, and so on. So, the market is really a conglomerate of a lot of different types of companies in different industries. And this is a very important message that I like to try to convey, or always convey, or convey too often to some people's taste, that it's a market of stocks, not a stock market. And people often ask me, Chuck, what do you mean by that? What I mean by that is that even though we can think in terms of the market, and that's what the Dow Jones, it's one of the proxies for the stock market, it's really a market of stocks and not a stock market. The market is comprised of individual companies that are in many ways entirely different from each other, and they also can be at different valuations, and they have different operating histories and different results. And so with a tool like FastGraphs, I can very quickly dissect the Dow or analyze it. Now, the first thing I'm showing you here is a portfolio review I built where I have put it in order by highest PE ratios to lowest. And what I'm really looking at with PE ratios is the all-important earnings yield. Those of you who followed my work know that I like an earnings yield of at least 6.5 or 7%. I consider that a minimum threshold. Not ideal, but minimum. If a stock isn't offering me, earnings yield of 6.5 to 7%, then I'm really not interested in investing in it because I feel like I'd be paying too much to buy it. So what does an earnings yield really mean? Well, it's the inverse of the PE ratio. It's the E divided by the P rather than the P divided by the E. And what it tells you metaphorically is that if you were 100% owner of the company and the company shared every dime of profit they made and paid it to you as the owner, this is what your yield would be, or what your return on your investment would be. And, so the point is, the average return of stocks is around 6.5 to 7%, even as high as 8 to 10%, depending on what time frame you're measuring. But my point is, I consider 6.5 to 7% a minimal return or yield that I'd be willing to even accept or look at a stock before I would take the risk of investing in what can be very, very volatile stock prices. So as you can see here, roughly of the 30 stocks in the Dow Jones Industrial Average, roughly half of them have an earnings yield of over 6.5% or higher. It starts with Amgen. Now, the last stock I got here actually has a negative earnings yield, and that's Boeing, because they're currently operating at a loss. But the other 14 above this have earnings yield below 6.5%. Now, if I look at something like Caterpillar, that's getting pretty close. I would even argue that AAA rated Johnson & Johnson is pretty close with an earnings yield of 5.8%. But when I start getting into these low earnings yields of under 4% or 4% or under 5% even, then I start to get looking at different levels of valuation. So what we're going to do here is I'm going to go through the 30 stocks in the Dow Jones Industrial Average very quickly. I'm going to look at them only from a perspective of earnings, and I'm going to look at them dynamically through the FastGraphs research tool to give you a sense of what the valuation of the market is. And, I think the market's half undervalued and about half overvalued. But even though it's down significantly for the year, I still believe that, there's a lot of stocks in the Dow that are overvalued. So let's go through it in alphabetical order. And of course, that brings me to the mighty Apple. And Apple, and I'm going to be looking at these stocks through operating earnings. And what I want you to see here is I'm looking at a long-term record. Clearly, Apple has normally traded at around 15 times earnings. Now, their growth accelerated a little bit in recent years. Let me put an average growth rate on here. The growth rate has accelerated, and you could argue that Apple, because of this high growth, is actually relatively undervalued, but the company only offers a 4% earnings yield, and importantly, it's only forecast to grow at around 6.5% to 7% going forward. I mean, this is already a $2.3, almost $2.4 trillion company. So it's very, very hard for them to grow much faster than that. So the bottom line is I consider Apple today very overpriced relative to the future, not necessarily the past, because their recent past has been a lot better, and I want you to understand that. But the forward earnings yield, the forward the ability of this company to continue to grow is suspect. Now, it doesn't make it a bad company. In fact, it's my favorite company on the planet, but I just think it's a risky investment now relative to whether you could have bought it back here in 2016 or 2019 even at PE ratios under 15, which would have been earnings yields of 7.5%, 8% or higher. So the first one we're looking at here is Apple, and it looks overvalued to me. The second one is Amgen. Now, Amgen, I want you to look at this from a long-term perspective. Company's grown double digits at about 13% a year. The 15 PE ratio has been an extremely good proxy for value. Now, valuation is never precise. The 15 on this graph is the orange line. Everywhere you see the price touching the orange line, it would be trading at a 15 PE ratio because that's what the orange line is drawn at. But you can see if I point to the black price line, there were times when it traded 11 times earnings, 12 times earnings. Even back here, we got into 10 times earnings. And right now, the blended PE ratio is 15.03, or we'll call it, reasonably valued with a 6.65% earnings yield. It's fairly valued now. It's not a bargain. It was a bargain back in November of 2021. It's now just simply fairly valued. Could you buy it today at that price? Yes. I believe if you look at forecasting, it's expected to grow just under 6% a year for the next average for the next couple of years. That includes only a 2% growth this year, followed by 6% in 2023, and forecast by a lot of analysts who follow the company to grow at 9%. The long-term growth rate on Amgen is expected to be about 5%. So Amgen looks like it's reasonably priced today, and it's approaching a 3% dividend yield, which is, very, very attractive. The next Dow stock is American Express. American Express, as you can see, trades within this 15 to 18 multiple. That's the blue line is a PE of 17.9. Now, these lines are dynamic. The blue line especially, you can see that since coming out of the Great Recession, a 15 or 15.48 to be precise, you can see the blue line is only a smidgen above the orange line. So around a 15 multiple is considered prudent, but obviously if you can buy it below that, you're going to also see, just by looking at this graph, that you can generate a much higher rate of return. And the company pays about 1.47 in dividend yield. They have a relatively low payout ratio. They did get a high payout ratio in 2020, but that was COVID. Otherwise, their payout ratio is averaging, 15 to 20%-ish. So, it's primarily growth oriented. Looking at it going forward, the company is expected to grow at just under 9%. It's 13% in 2023 and 14% in 2024. But it's supposed to have a negative growth rate, which explains why stock price may be down this year, because we're facing a negative year, but then followed by some strong years. And you're always investing looking forward if you're prudent and smart. It's the future that matters the most. Boeing is another one of the 30 Dow stocks. As you can see, the company's lost money now for several years in a row, 4 years in a row. Expected to start to recover. Really doesn't have a PE or an earnings yield because there aren't any. There's no E to measure that with. What the company might look like going forward. If you're willing to be patient, in a couple of years from now, there may be a return available. Buying the stock is a speculation, but you got to recognize fundamentals right now are, awful. But this is what Boeing looks like. It's a market of stocks, not a stock market. Looks totally different than the ones we've looked at previously. Caterpillar is what I call a semi-cyclical company. It's trading just a smidgen over that PE line of 15, but as you can see, that's been a very good proxy for value for all these years. It was overvalued in 2021 and started out in 2022. It's now moved into fair value. The company is expected to continue growing for the next couple of years at about 13%. I think that makes sense with infrastructure. So this might be one of your better candidates because even though its current earnings yield is a little subpar, only 6.4, and I like 6.5 or higher, but that's obviously close. The future growth here is expected to be so much stronger or be very strong, which makes it, I think, an attractive candidate. And, can you buy it now? And if it did drop in value like it has many, many times before, that simply gives you an opportunity to buy more. This is not the kind of company that I think you should sell. It's A-rated. It's a very excellent company, has a great dividend record, and currently offers a dividend yield of over 2.5%. Salesforce, as you can see, the normal PE here is kind of distorted because of some high valuations. Back here, it's always traded at high valuations, but that's starting to catch up with it now because you can see growth was 28.7%, then it was 31%, but then as I shorten the time frame, we're starting to see growth begin to subdue. And if you're looking at forecasting for this company, even though it's A+ rated, it's forecast to grow at 14%, but it offers an earnings yield under 3% and a blended PE of almost 34 times earnings, which makes this stock still look very, very expensive relative to its future growth, even though we've already had a pretty major correction in the company. The next stock on the list here is Cisco. Cisco is, obviously, a major communication equipment company. We all know about Cisco and their products. You can see how Cisco was overvalued and have some aftermath after the tech bubble. And it did very, very poorly as a stock for many, many years. And I'm not going to hit peaks and troughs. I'm just going to try to give you a sense that it had a negative rate of return from October of 2003 to August of 2012. But yet the company grew its business every year. And this is the reason for valuation. The stock was overvalued at the beginning of the year. It's become cheap now, offers an earnings yield of 7.81%, a dividend yield of 3.49%. And it's forecast to grow at about 5.5 or 6%. But because of the margin of safety given here, and the stock is so inexpensive, it does offer potential to make double-digit returns or higher over the next 2, 3, or 4 years if you were buying Cisco at these low valuations today. The next stock is Chevron. Chevron, the oil industry has been going through an awful lot of political turmoil, as we know. The stock has really done very little. It does offer a 3% dividend yield. There is expected to be a recovery with oil prices rising like they have in 2022. But then we're looking at some shaky numbers going forward. This is a tough one. The long-term growth is still expected to be excellent, but there's going to be some interruptions as there have been in the last several years. The company is AA- rated, has very low debt, so it is one that's possibly worth looking at. By the way, you can look at companies from a lot of different perspectives with fast graphs. This is looking at it from a standpoint of operating cash flow covering the dividend. And you can also look at whether free cash flow covers the dividend. And you can see there have been a couple of years where it didn't, but they still raised their dividend, but modestly nevertheless. So Chevron, looks like it's undervalued today. Earnings yield is 9.5%. Dividend yield is 3.28%. But you've got to consider the fact that there's going to be some potential bad news coming up in the future. Disney, Disney got hurt very badly by COVID, forced them to cut their dividend. Expected to reinstate one, but they're not paying one now. You can see the stock has fallen dramatically. Fundamentals matter, and fundamentals matter a lot. I consider this company still significantly overvalued relative to the expectations of what future earnings might be. It's got a low price relative. You can look at the low price and you can see back in 2015, it was trading at approximately what its low was in 2022. But the point is, the earnings have fallen off a cliff and they are expected to start recovering again. So I would call Disney a speculation. You're looking for the dividend to be reinstituted, et cetera. But that's Walt Disney. The next stock is Dow Jones itself, or the Dow company. It's a spinoff. It's only been around for a couple of years. It looks very inexpensive, but also very cyclical. And there could be some really bad news, coming in the next couple of years that could even drive the stock lower. So this would be one that, even though it's, looks like it has an extremely high earnings yield, a very low PE of under 7, you got to be careful with what might be happening in the future. Goldman Sachs is a quasi-cyclical, investment banker and brokerage company. They do a lot of big underwritings. They've had some really great years and the stock has responded. It does look very inexpensive. Their dividend record has been really good. They've not cut the dividend, but they have froze the dividend a couple of times in the past. It's currently yielding over 3%, and the blended PE is 8.5, giving it an earnings yield of almost 12%. So I'd say Goldman Sachs looks very, very attractive, especially as an income play. But again, do expect, there was some softness in the stock for a bad year, but they are expected to recover very strongly in the next couple of years. But again, do your own due diligence and research. But that's what Goldman Sachs looks like. The next one is Home Depot. Home Depot was very richly valued. I want you to notice how this stock traded at a 15 multiple for all these years, even when it had very good growth rates. And then we went through a period of time coming into the Great Recession, I like to call it, where, earnings actually got real weak for 3 years in a row. Earnings fell for those 3 years, but they still were a profitable company. And then a couple of years following to 2009 recovery, the stock started to trade at a very high premium PE. It's now a lot cheaper than that. Growth rate has accelerated up to, 15.69%. I would call Home Depot attractive today, but I wouldn't call it cheap, especially if you're considering long-term double-digit growth. This could be a safe time to buy the stock. And if it fell from here, it would be the kind of stock that you'd want to add to. It's A-rated, but it does carry an awful lot of debt. That's something to be, taken into consideration when you do your due diligence. Honeywell is one of the overvalued stocks in the S&P. I just think it's too expensive. This has normally been a 15 to maybe 18 multiple stock. And again, I'd rather buy it at 15 than 18. I always want to make that clear. But it's trading even at a higher PE than that. It did have a minor drop in earnings during COVID, but it's been recovering ever since. The company does look like it's expected to grow at about 8 to 10%. So it's a good company, A-rated, strong. It has modest debt of about 35% debt to capital. What I don't like about Honeywell is the valuation. IBM has been one I've written about several times. I think this is a company in transition. This company did go through a period of time where it had great growth, and then it's been transforming its business, getting away from the mainframes, moving more into the cloud. It does offer an attractive earnings yield right now of 6.71% and a very attractive dividend yield of just under 5%. I think IBM is starting to get its sea legs back and starting to grow again at 7 or 8%. The long-term growth expectations are 8.25% by the analysts that are giving that. And the more mid-term estimates expect to have a really strong year this year, followed by 5 and 4% the next couple of years. So I do like IBM here as an income vehicle, and I think it's one of the ones that are reasonably priced in this market. Intel earnings have fallen off a cliff. Intel is expected to see earnings begin to recover. So if you're looking at recovering earnings, Intel could be a good buy here as, again, a company in transition. Good, strong company, A+ rated, only 24% debt, and it's offering a dividend yield of over 5%. And I do believe this company possesses the operating cash flows as well as the free cash flow to keep their dividend intact, although free cash flow has really turned negative temporarily. This is really important, depending on how long that lasts, and you can see how the stock price has reacted to that. So again, you'd have to call it a high-quality company. You'd have to call it a speculation, given what's happening right now with their cash flows. Johnson & Johnson, one of the two AAA rated companies on the planet, trading at a 5.85% earnings yield, a blended PE of 17, which is on the upper end of its, what I would call normal valuation. The time to buy Johnson & Johnson is when it's, cheaper if you want to fully participate in the company. It is expected to grow modestly for the next couple of years and long-term modestly as well. So, again, it's become a big company, but it is AAA rated, and I think you can't, it's hard to go wrong. They've got a tremendous amount of cash. We were looking at their financial statements just yesterday, my son and I, and it really looks, good from a cash flow. JPMorgan Chase is a financial. I want you to see the normal PE was, 15, but in more recent years, you can see the company has traded more at 12 or 13 times earnings. It's only trading at under 10 times earnings right now, offers a 3.25% dividend yield, and it has a very good dividend record historically. The company has maintained their dividend and even grew it a little bit. For most of the time, they did have a cut during the financial debacle, which is understandable, maybe, perhaps, but since that time, they've been growing their dividend again ever, so strongly. If we look at it from a standpoint of, let's say, the last 12 years, and I look at performance chart, the dividend growth has been averaging about 13.8, compounded 14.1 on average. So, with a decent dividend yield now of over 3%, growing by, possibly 10 or 12% or more, I think JP Morgan looks good as a financial. It's A-rated. We don't report debt on financials because debt is sort of their product. Coca Cola has been a premium valued stock forever. It doesn't grow anywhere near as fast as some people think it does. It has traded at a premium valuation quite a bit. It's almost better to look at Coca-Cola from cash flows, but no matter how you look at the stock right now, even looking at it with EBITDA, I think the stock looks rich relative to what its potential, future growth potential is going to be. So, I know Warren Buffett owns it. I know it's been a great cash flow generator. It does offer a 3% dividend yield. I just think the stock is a little expensive here at these levels. Only gives me an earnings yield of 4%, but it does give me a dividend yield over 3%. That's been one of the real attractions to Coca-Cola. Here's McDonald's. McDonald's is just one of the really overvalued stocks. Even though the Dow has fallen as much as it has this year, this stock continues to defy gravity and remain at a very high valuation. I really, really like this company a lot. What I don't like is the heavy debt load, and I don't like the high valuation. So I'm not a buyer of McDonald's at these levels today, even though I think the company is very good. I've done videos on 3M. I think 3M is very inexpensive. I think the company does face some problems. Everybody is aware of that, but I think their problems are solvable and their business is pretty much intact. The company is expected to grow at around 3.5 or 4% a year. The advantage of buying 3M here is the margin of safety. It's trading with an earnings yield of 8.67% and a PE at 11.5. That's pretty cheap to buy an A+ rated company, in my opinion. Next one I'll look at is Merck. Merck has been benefiting from, COVID. As you can see, the last 10 years, their growth rate has turned double digit again. The company's forecast growth rate is expected to be double digit as well. Even their long-term growth is expected to be double digit. So Merck, with a 2.8% dividend yield and an earnings yield of 6.74 and an A+ rating, is probably a very attractive company to consider for either total return or dividend income if you're looking for either. Microsoft is, it's been a 15 times earnings company. It has had an acceleration in earnings growth, but there are some who believe that the growth, is over. The company is still considered to, expected to grow for the next foreseeable future at double-digit rates, but you're paying a very high premium or very high price to buy that. I'll give you, it's better than it used to be, but it's still not good enough. The earnings yield is under 4%. The dividend yield is just slightly over 1%, and the PE ratio is over 26 times earnings. There's a lot of stocks that have these kind of characteristics that you can buy, even though it is a AAA rated company, one of the two AAA rated companies in the world. Price is what you pay, value is what you get. Never forget that. Nike's been a high flyer for a long time. all of a sudden the stock price is starting to come to some semblance of reality, but I don't think it's there yet. The company still trades at a very, very rich PE ratio, does offer a modest earnings yield and a modest dividend yield. I think the company is very expensive relative to its future growth. So even though it's fallen quite a bit, I think it had a long way to fall, and I don't think it's over yet for this company. Procter Gamble is a similar story to Coca Cola. It trades at a premium valuation. It's coming back towards that valuation, but it's not quite there yet. It does offer a 2.8% dividend yield, but I'd like to see the yield be a lot higher and the valuation a lot lower. It is AA minus rated with a 27.6% debt to capital ratio, which is very good. Travelers is another financial, property and casualty. Very good dividend record, 2% yield, earnings yield of 7%. PE is under 15. It's a little pricey relative to its recent history. It's, been trading at around 12 times earnings. It's now trading at around 13.5. Looking at it in the future, it is expected to grow at around 7% a year, which makes it, gives it about a 10% margin of safety. But if you're looking at the normal multiple, the last 5 years, probably just fairly valued. You could look at it, over a longer period of time, like the last 6 years, and it would be trading at a slight premium. Anyway, that's Travelers. It's prudent at this point. It's not necessarily cheap, and it's certainly not expensive. Next one is UnitedHealth. UnitedHealth has an impeccable history. It's A-plus rated, less than 36% debt, offers an earnings yield of only 3.96% and a div yield of 1.22, and that's strictly because valuation is extremely high here. And I love this company, but I don't like its valuation. It's that simple. But there's UnitedHealth. The next stock is Visa. I have owned Visa when it was trading at a PE ratio equal to its growth rate. Its future growth is expected to be about 16% a year, which gives it a 15 to 18 PE multiple valuation. Long-term growth is expected to be 18%, which would give it your 18 multiple. I love this company. I like the stock a lot, but I do think it's still trading at a premium valuation. It's only been since, 2012 that it's traded at these high valuations. Like Visa, I just consider it expensive. Verizon has been much maligned. The fundamentals tell a totally different story than the stock price. It's trading at an earnings yield of almost 14.5%. A PE is under 7, and the dividend yield is 7.26%. And if you look at their dividend growth history, they've been growing their dividend at about 2 or 3% a year for the last several years. And I think they still have the capacity to do that. The real consideration here is not the growth, which is expected to be technically negative. Long-term growth is expected to be less than 1%. It's the valuation, because even a low growth or a no growth bond has a valuation that's worth more than 6 times earnings. So I would put this company at a valuation using a very low, under 10 multiple. This stock would give you the opportunity to give you double-digit rates of return, half of it coming from dividends alone. If I'm looking at it from a standpoint of the normal PE of around 12, this company gives a real good margin of safety and has just astounding annualized rates of return ahead of it, considering PE expansion and recovery. So Verizon, to me, looks very, very attractive, even with subdued growth. Walgreens Boots Alliance has been under a lot of stress lately relative to their stock price. Their fundamentals have been a little choppy, but they are indicating a lot stronger fundamentals than the current stock price would say. The stock's blended PE is 6.9, or we'll call it 7, earnings yield of over 14%, dividend yield of over 5%. And again, the dividend has been growing at very modest rates for the last several years, but its long-term average has been much higher. So, this is a company that if you expect a turnaround, the forecasting graphs do show they expect the company to start growing again. The long-term growth rate is given as negative right now by these analysts. Again, this is when you want to do your own homework in. You might want to check other websites. But the real allure here to Walgreens Boots Alliance is how cheap the stock is. Walmart is one of the overvalued stocks in the Dow. I just think it's too expensive to invest in here at these levels. It would be nice if you could buy it at around 14 times earnings. Currently trading at 23 times earnings with a 1.6% dividend yield. Again, I think Walmart's a great company. It's AA rated, has 33% debt. but you're just, again, price is what you pay, value is what you get. You're just paying too much for it. Anyway, this has been Chuck Carnevale, co-founder of FastGraphs, Fundamentals Analyzer tool. You've asked me if I looked at the Dow lately. This is how I look at the Dow. This is how I can look at even the S&P 500, the S&P 400, the S&P 100, going through a similar process as this. I can create portfolio reviews, assess valuation. So, FastGraphs is a wonderful tool. You ought to take a look at it. If you like this video, give me a like, ring the bell, share it with other people if you be so gracious as to do that. And I look forward to talking to you guys again very soon. Thanks for watching.